Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, Certified Financial Planning Professional, the CAP in Capitalize. On today's episode, we are going to talk about tax-saving strategies for the self-employed. Now, whether you are a solopreneur where it's just you, yourself, and you that are running the business, or you have a multitude of people under you, or what we'd call a traditional business, there are a lot of things that you are probably not doing that is leaving a tremendous amount of opportunity on the table. And in your defense, a lot of people, as they're growing their business, when you start a business, you're probably not making a lot of money. In fact, that's most cases. However, as you start to become profitable, and in some cases incredibly profitable, the main thing that I see people really screwing up is they keep the same habits and tendencies that they had when they weren't making money. So what we're going to do today is we're going to talk about some of the best saving strategies that you have, not only from a tax side of things, we're even going to fast forward all the way to the end when someday you have that exit and how you can properly capitalize on the sale of your business. Now, before we get into today's episode, The Belly of the Beast, if you are interested in the masterclass, the books, and previous episodes, head on over to capitalizepodcast.com. That is where our master hub is for all of our capitalized content. So without further ado, let's get into the show. There were a million ways I could have started this. And I first wanted to start with, in my humble opinion, the easiest wins that you have at your fingertips. And by easy wins, I'm talking about retirement plan options. So there's a number of options that you have out there. There's something called, there's an individual retirement account, whether you run a business or not. There is something known as a 401k, which is the most commonly referred to retirement plan for businesses. There's also something called a 403b if you run a nonprofit, a 457b if you run a governmental agency. There's something called a SEP IRA or a simple IRA, which we're not going to get a ton into, especially simples. There's kind of a little joke that we have within our office. Simples are stupid. You don't want to use them just because, frankly, there's so many better options out there. But there are those options, and I have to talk to you about them. With the retirement plans, the reason why I like to start with this, a lot of people forget that the best investment that you can guarantee, other than in yourself, is not actually an investment. It's the taxes that you avoid. And we talked about this an extensive amount on this show, but it's worth repeating. And with business owners, especially if you're doing well, let's face it, the highest tax bracket, depending on if you're in certain states that are tax unfavorable, you could be anywhere from 40 or in some cases, even like California, up to 60% of your money is going to the tax man. That's not enjoyable at all. So with a retirement plan, it is a simple yet effective way to avoid a lot of those taxes. Now, if someone doesn't know where to go with the retirement plan options, I would say that there are tiers to setting up a retirement plan. So if you just started out and you're trying to figure out your business and you're not profitable, frankly, you probably don't need a retirement plan because you're not going to be able to afford to put anything in it in the first place. Once you have a little bit of profitability, depending on how much profitability, that's when you'd want to set up an individual retirement account for yourself, or maybe a Roth IRA if you're not in a high enough tax bracket where you actually could pull off a Roth IRA. You could set up something known as the simple IRA, but again, I'm not going to get into the weeds of it just because I'm personally not a tremendously large fan of a simple IRA. Most of you are going to want to set up the 401k, assuming you run a privately ran business. And the reason for that is, number one, unlike an individual retirement account, you're obviously using this for you and all of your employees. Number two, you can put in a whole heck of a lot more to a 401k. With an individual retirement account, if you're under 50, you can only put in, as of 2024, up to $7,000. $7,000. Thank you. And then with your 401k, you're able to put in up to $23,000. And that's just as an employee. When you add the employee portion of $23,000, something known as an employer contribution, which again, you are the employer, but not in the eyes of the IRS, and then something known as a profit sharing contribution, you could get over $60,000. That's $60,000 into your retirement, which is going to lower your tax burden substantially. I mean, let's just use easy math. If you're in the 50% tax bracket, which a lot of our business owners are, when you add everything up, you put in 60 grand, you are earning $30,000 in taxes you're not going to owe for the next tax season. That's huge. And that doesn't even include the compound interest over time. And then eventually when you retire and you are in a lower tax bracket, more likely than not, you avoided a ton of tax that you're never going to pay to the government. So when it comes to the best tax saving strategies for self-employed, make sure that you understand the retirement plan benefit side of things. And one little cherry on top before we move into the next section, and I don't talk about this a ton because it is significantly more complex than the average retirement plan, but there's something known as a cash balance plan. So back in the day, there were no 401ks, and we're talking way, way back, where you would work somewhere, you'd retire, and then you'd have a pension. Pensions are a thing today, and pensions fall under the category of a defined benefit plan. And the reason why they're called that, it's really, really simple. You know what your defined benefit will be on a monthly basis when you are retired. I mean, it's pretty cut and dry. When retirement plans like a 401k came into play, those are considered a defined contribution plan because you can define, I don't mean to sound like a broken record, how much you can contribute up to that dollar amount per year. Now, you don't know what your benefit will be by the time you retire, but with prudent compounding and research and maybe reading Capitalize Your Finances, you will, in theory, earn more than what that benefit would pay you down the road. Now, I say that because a cash balance plan, it's kind of a hybrid. Technically, it falls under the category of a defined benefit plan, but as an employer, you can dictate how much you want to contribute to the plan. And it's the cherry on top. So let's say that you're doing really, really well. And let's say, and I'm just going to use examples for businesses. Let's say that you run a dental practice or you run a HVAC company and you are just printing money. And $60,000, I'm not saying that's not a lot of money, but you're able to put in that easily to a retirement plan. A cash balance plan, you could basically put that on top of your 401k, and depending on age and in variability of age with the rest of your employees, you may be able to put in an additional $300,000. And not only does that avoid the tax bracket you have today, that also avoids Social Security and Medicare tax on top of that. Now, you can't have your cake and eat it too. You have to earn a certain return, very similar to a pension. However, you utilize that strategy for the tax savings, not necessarily from the investment side of things. So for those of you that are listening, that are self-employed, that are absolutely crushing it on that end, send me an email, chris@capitalizeyourfinances.com. I'm more than happy to go over that. But that gives you basically from top to bottom all of the tools in your arsenal to successfully mitigate taxes as someone that's self-employed. Now, the second point I want to go over is the investment side of things. So we already went over the types of accounts that are worthwhile investing in. 401k, maybe a SEP IRA, things of that nature, cash balance plan. But once you have those in place, the next question becomes, how do you invest that money within those accounts. So let's say that you're a young, self-employed business owner and you've got this super long-term time horizon, 20, 30, in some cases 40 years until you're going to retire. Within your, let's just say you have a 401k, where do you go with that? If it's just you and you don't have other employees, frankly, you want to make it as simple as possible, but because you're not dealing with anyone else, you could get a little bit more custom. So on previous episodes, I've enlightened our listeners about the endowment model. It's one of my top ways to grow clients in my own net worth. That is utilizing a combination of the stock market, real estate, private equity, which is privately owned businesses as opposed to publicly traded stocks, private credit, which is lending. You could use hedge funds. I'm technically not a huge fan of hedge funds on the whole. Interval funds, which are kind of like mutual funds within the stock market, but unlike mutual funds, interval funds, you can get a little bit more creative on how you invest in them. I'm listing all of these out. I'm not saying that you have to utilize all of them, but what I am saying is with your 401k, if it's just you can kind of get creative if you have a planner that knows what the heck they're doing on being as prudent and sophisticated or simplistic as you want within your retirement plan. Now, with a IRA or a SEP IRA, it's the exact same. What I would tell you is if you have a 401k and you have multiple employees, I can just speak from my own experiences because we have clients, we've got about 32 businesses where we oversee their retirement plans. And you want to, and it's kind of like herding cats because you want to make sure that you and your employees are obviously on the right path. But by definition, you cannot get uberly custom with every single person. You kind of have to think of it as going to Costco. You're buying in bulk. It's no different than the retirement plan world. So if you've got a ton of employees, chances are you're going to want to have much more traditional investment options at your fingertips. And that would be like the stock market, bond market, maybe some cash alternatives like a money market fund or a CD fund or something called a stable value fund. And you want to make it really, really simple. Now, I'm telling you this because if you make your retirement plan super simplistic, let's say you're making money above and beyond that, and you've got money outside of your retirement plan after you max out your retirement plan. You go, how do you go and invest that? Now, again, very similar to what I said earlier with stocks and alternative investments. If you're closer to retirement, I would say within 5 years, for sure within 2, that's where you need to start to utilize a lot of these short-term vehicles. And frankly, I would just message me, chris@capitalizeyourfinances.com. But for those of you that have that long-term time horizon, if you max out your 401k, you've got that money in the market, anything above and beyond that, if it's not in a retirement account, you've got to be mission critical of the taxes, because unlike a retirement account where you're avoiding the tax until you pull the money out, with non-retirement accounts, I kind of call those naked accounts, because if you buy or sell a stock or a piece of real estate or a privately owned business at a gain or a loss, there are tax consequences. And I don't mean consequences as a bad thing. It's just there's going to be something that you need to be aware of. Personally, I would much rather be a fan of utilizing something more tax efficient within the stock market. I'm not against mutual funds. In fact, my 401k is through mutual funds. But when it comes to non-retirement accounts, I would prefer on a tax strategy standpoint and a fee strategy standpoint, you're probably going to look at either exchange-traded funds, which index funds are what they're known for, but that's not the only type of fund out there. Or you could also utilize individual stock holdings. And the reason why I bring that up is I'm not against mutual funds, but the bummer with mutual funds is you cannot get as custom from a holding standpoint and then a tax standpoint, and not to mention a fee standpoint. Once you get into the alternative space and it's not within your retirement accounts, that's where I would look into something where if you've got real estate, let's just use real estate as an example because it's really easy to understand. You buy a piece of real estate, whether it's a multifamily apartment, a home, a warehouse, whatever. Real estate gets old. Shocker. And so over time, that real estate will depreciate. It gets old. It's worn down. Well, within the tax code, you can earn what's known as depreciated income. And I don't even need to get into the weeds of that, but what I'm saying is that income that is depreciated income, you are deferring that tax. So you're not actually paying that until someday when that real estate is either fully depreciated or you go and sell the property at a more tax favorable rate, capital gains. If you hold that within a retirement account, you don't get those tax benefits at all. And that's a bummer. Same thing with private equity, because with privately owned businesses, you get tax benefits, no different than your own business today. Now, private credit or lending, the bummer with those strategies, and I should say bummer, and for those of you that aren't watching, I'm using this in air quotes, your tax ordinary income. So in a perfect world, if I'm splitting hairs here, I would much rather utilize those types of alternative strategies within a retirement account as opposed to a non-retirement account, because if you're in a higher tax bracket, you're going to be paying more in tax. Now, again, there comes a point where you cannot avoid tax altogether, but if you can control that to the nth degree from an investment standpoint, why wouldn't you? And so we went over the different accounts. We went over the different investment styles and investment strategies, both within your retirement accounts as well as outside your retirement accounts. And after the commercial break, we're going to go over the number one thing that you need to know as far as who you need to surround yourself with the perfect financial team. And then we're going to conclude this episode on rounding out, by the time you get to the point where you sell, how you can tax efficiently keep as much money in your pocket after you have the massive exit. So stick around, take a sip of water, relax, and we'll be right back.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back from the commercial break. As promised, we're going to round out this episode of tax-saving strategies for the self-employed, and we're going to talk about the team that you're going to need to surround yourself with to have the most successful business from a financial perspective. So right off the bat, and you're probably assuming I'm going to say, oh, you need a qualified and a quality certified financial planner like yours truly. That's actually not the first place I would go. I would say before you do anything, if you do not have a quality CPA in your corner guiding you and your business through the tax strategy of that business, you are setting yourself up for a world of hurt. Occasionally, I have seen businesses decide to hire enrolled agents, which they can't necessarily do everything that a CPA can, but it is a much more affordable option, and they can get you pretty far. And I am not knocking the enrolled agents out there. For those of you that are listening that are enrolled agents, I have a number of friends that are enrolled agents, and they're highly, highly qualified. But due to the regulation, your hands are going to be tied on some things, and that's okay. But you want to make sure that you've got a quality tax strategist in your back pocket. Now, one of the things that I think about with the CPA is maximizing deductions. My brother and I talk about this a ton, and we kind of nerd out about like, are you writing this off? Heck yeah, I'm writing this off. Are you writing this off? Absolutely, I'm writing this off. You want to make sure you are deducting legally as much as humanly possible. And one thing I want to quickly dovetail on is this is kind of like business strategy 401. I learned about this indirectly through one of my guests that I had on, Adam Cecil. Adam Cecil is one of my favorite investors. He's become a really good friend of mine, and he wrote one of the best investment books of all time, Where the Money Is, How to Invest in the Digital Age. It came out in 2022. And it was interesting because what he was talking about, and this is where it's going to relate to you, a business owner, no matter what business you're running. According to our generally accepted accounting principles, GAAP, businesses today are obviously totally different than when these principles were written decades ago. And there's a classic example. Take an old school company like Campbell's Soup and compare it to a new company like Google. I'm picking those two out of a hat. Campbell's Soup, they've got factories, they've got drivers, they've got tangible things that they buy. And so when you buy factories, you get to write it off over years and depreciate. With a technology company like Google, or just a technology company maybe in general, these companies don't have all of these old school assets. They don't have a ton of factories, and they don't have a ton of drivers. They don't have a ton of these tangible assets that they can depreciate over time. And so what Adam Cecil's argument is all of those asset equivalents are in research and development and marketing expenses for these companies. Now, that's as far as I'm going to go as far as like the investment nerdiness, but why is this valuable for you, the business owner, to understand? You need, along with that CPA, to truly understand the value of utilizing proper marketing and proper research and development. So I'm going to give you a couple examples, and I'm actually going to utilize my own business. So let's say that hypothetically, I took $50,000 and I wanted to reinvest that into my marketing expenses. My social media manager would love that. So $50,000. Let's say it takes me 3 years to get that money back. And then after that, it's pure profit. If it takes 3 years to get my $50,000 back from a return, we call this return on invested capital within the investment world, but my return is 33% on my money. If it took 5 years, because it takes longer, the return goes down, it takes about 20. I can tell you those are both phenomenal rates of return, but something even better, I would have to take that $50,000 as an expense deduction this year. I don't write it off over multiple years. So, assuming my business is in a pretty high bracket of like, let's call it 40%, $50,000 times 40%, okay, that is $20,000 in taxes that I would hypothetically not be paying today. So $40,000 in tax you're saving, and then 33% just as a pure return on your investment. And so by having these conversations with your CPA or enrolled agent, if that's the route you decide to go, but for sure your CPA, you will understand one of the most highly complex, highly sophisticated, and most valuable tax saving strategies for any business out there. Now, the last thing I wanted to talk about is when you're eventually going to retire. As my dear friend Lori Barkman, who wrote the Business Transition Handbook, she mentioned this: plus or minus 100% of businesses will either go out of business or be sold off and acquired. It's not wrong. And so you've got to be thinking about this. I don't care if you just started your business, you have to think about what that exit's going to look like. Now, if you're a young guy or gal that just started your business and it's going to take you 20 or 30 years and you have no end in sight, obviously you're not going to be preparing to sell tomorrow, but you've got to be thinking about these strategies. I would actually recommend you pick up Lori Barkman's book, The Business Transition Handbook. It was one of my favorite books of business strategy I have ever read, and it gave me a ton to think about with my own business, because someday, it's going to be years from now, but someday when I sell, I want to maximize the value for my own business. And I think you would want the same for you. So when you retire, there are a number of different tax saving strategies that you have at your fingertips. And I'm going to throw out a couple different ones. The most traditional and easiest one to understand is what I just call the flat sale. So, let's just say hypothetically, I meet with someone, they decide to buy the business for whatever, and they strike a check, I'm done, I'm out. Maybe I'm on for a month or two to transition the business, but you're done. All of that gain that you are going to incur from the sale of the business, it's a capital gain. It's not ordinary income. And so with a capital gain, there are a number of different strategies that you can utilize to not only defer, but in some cases, potentially avoid that tax altogether. Now, I'm not going to get into the weeds of it, and there's a couple reasons. One, it gets super complex. Two, compliance has limited me on getting into the weeds. So if you have questions on these strategies, hit me up. But you could utilize a combination of opportunity zones, which is a type of real estate. I definitely don't see this utilized as often, but conservation easements can be a unique way of deferring some of that tax. And then because interest rates are so high, this is one of the easiest ones. Let's say that you you have a business and you sell it for $5 million. Well, that's a lot of money, but a lot of that's going to go to tax. So let's say that you're in suddenly the 25% tax bracket. Okay? So the next year, out of that $5 million, about 1.25 or 1.5 of that is going to taxes. Ouch. But because interest rates are so high, you could go and purchase a variety of these short-term investment options and strategies that may be earning 4-5%. And so, you can't avoid the tax, but by the time that money comes back to you, maybe a month or two before you actually pay the tax, you've earned 4 to 5% on $1.5 million. That's not an insignificant amount of money at all. And that's mission critical. Now, another strategy that we see all the time is the installment sale, where you get paid over a number of years, whether it's 2, 3, 4, 5. I've seen some as long as 10, but that, frankly, at that point, any business owner that's basically watching that for 10 years, they just want out. So let's say that you're getting paid over 5 years. Generally speaking, if you're getting paid over 5 years, a lot of these business owners with this transition, they actually stay on either under that new company or they basically are contracted as a consultant over that 5-year period, and they're getting paid that way because, again, they're not in the business, but they're transitioning that business on a gradual basis. So if you're paid, let's just say 5 payments of $1 million, capital gains, okay? Pretty cut and dry to what I said earlier, but instead of doing that just one time and you're done, you basically ladder that strategy or strategies every single year. On top of that, if you are a contractor, and let's say that you are earning a couple $100,000 from that, talk to your CPA, you could then set up a 401k and maybe even a cash balance plan if it's the right move and defer some maybe a lot, and occasionally all of that over those 5 years. Because why do you need any more ordinary income? You're getting it from the partial sale of $1 million every year. And if you can't figure out how to live off that, I don't know what to tell you. And so unlike the lump sum, where there's pros with that, it's done, it's easy, and it's quick, and it's painless. The installment sale, it can be more emotionally painful because, let's face it, if your business is your baby and you see it change in front of your eyes without any of your control over 5 years, that's going to hurt. But on the flip side of that, you can get infinitely more creative with the tax strategy side of things. And then one thing that we like to see is when all the dust settles and the business is sold and everything is complete, that's when you start spending the ordinary income tax dollars down first, which would be like your retirement account, and you let your taxable money grow because that's more tax efficient money. And so in retirement, then you're just walking down this tax ladder and you're basically making more money and paying less in tax. That's what we call the dream. Okay, that's what everyone wants. The only caveat is if you have a charity or charities of your choice that you want to give to, then you could basically take that retirement money, you could invest it kind of however you want, and then once you get to the required minimum distribution age of 72 as of this recording, you could basically take up to $100,000 every year and convert that to a qualified charitable distribution, and that money that is pre-tax goes to the charity. It jumps over your tax return. You're actually never paying any tax on that, and you get to give to a charity of your choice. So that does it for the tax saving strategies for the self-employed. I know at the very end, we went from 0 to 100 extremely fast, but I really hope you got a lot out of it. This is one of those episodes that you're going to want to go back and listen to maybe once or twice. You're going to want to take a lot of notes. If you are listening to this and you said, hey, I would love to be a guest on Capitalize Your Finances, this podcast is fan-freaking-tastic, or you have personal financial planning questions that you'd want me to answer on the show, or you just have questions you want to shoot at me and see if I can help you out, head on over to capitalizepodcast.com, shoot me and my team an inquiry. We look at it every single day, and we try to get back to you as soon as humanly possible, ideally within 48 hours. But again, there's no guarantees in life, but we do our best. As always, I am your host, Christopher A. Paniotu, certified financial planning professional, the Captain Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstance. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. The information provided is based on current laws, which are subject to change at any time. Capitalize Your Finances is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Interval funds are essentially illiquid. Repurchase is done on a pro rata basis. there's not a guarantee that you can redeem all your shares during a redemption window. Money market mutual funds, though traditionally lacking federal insurance, are not without risk and are highly regulated under federal law. Stable value funds can be viewed as an alternative to money market funds. However, there are important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. Before investing, carefully consider an interval funds, mutual funds, or stable value funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Exchange-traded funds, or ETFs, are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Christopher A. Paniotu is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.